These bond markets have been shaken a little bit. We're above 4%. I hear the supply issues you raised in the autumn time. Bill Gross doesn't think that they offer value at this point. On sovereigns in the US at around the 4.25%, do you want to scale back into this kind of sovereign debt at these kind of levels? Good morning.
Well, good morning. Thanks for having me. Yeah, I mean, so we think for longer-term investors, the bond market still provides a lot of value. If you look at high-quality credit, securitized markets, you're still getting relatively elevated yields, especially if you think, as we do, that ultimately the underlying neutral interest rate in the U.S. economy, is probably still around 0 to 2% on a real basis. And if we compare that to longer-dated real yields, for example, they're still elevated, but nevertheless, and this is where it's important to have, an active bond manager. Nevertheless, when we look at, the front end of the interest rate curve, the Fed funds futures strip, we do notice that there's a lot that's already priced in terms of central bank cuts just in the near term. So I think, over the longer term, bonds provide value. Kind of as a tactical trading perspective, though, the bond market's priced in a lot in terms of cuts.
What will we get from the Fed, 3 or 6, or something a little bit even more muted than the 3 that the market has priced in?
Yeah, well, what we find when we look historically is that central banks tend to lag in their cuts. In other words, they don't start cutting until they're pretty certain that their economies are in recession. Now, nevertheless, and then when they do cut, they cut much more than what the market's priced in or what forecasters are expecting. Now, nevertheless, there's a handful of cycles historically, where central banks have managed to cut without an impending recession. In those, quote, soft landing cutting cycles, on average, the central banks tend to be cutting about 200 basis points. So that's, in the first year after the cuts start. So that's about twice the pace than what's currently in the SEP, for example, than what Federal Reserve officials expect. Overall, when we take a look at it, we think it's a reasonable baseline to think that probably the Fed is going to be a little bit more delayed than what the markets are currently pricing. But again, nevertheless, when they do start cutting, they'll probably be a little bit more aggressive, than maybe what they're forecasting. But when we look at, what the bond market is currently pricing, we're pretty much priced for a soft landing outcome. And that's the case, when we look at equity, we think that's the case when we look at equity valuations or riskier, credit, lower quality credit as well. So to us, when we think about longer term valuation of the bond market, it still looks good relative to your risky alternatives, even though, from a near-term tactical trading perspective, we could see, some of those cuts getting priced out. Of course, the path from here to there is never a straight one. It'll probably continue to be bumpy.